In January of 1991, the world held its breath. Operation Desert Storm turned the skies over Baghdad neon green with tracer fire. For 100 hours, a coalition pushed Saddam Hussein's army back into the sand. The markets dipped, oil spiked, and then it was over. But the financial puppet masters learned a dangerous lesson in that war. They learned that the Persian Gulf is not a region. It is a ventricle, a muscular chamber pumping the lifeblood of global trade. And today, that ventricle is showing signs of an aneurysm. This is not a history lesson. This is a warning. Welcome to the Money Files. Today we ask, could a single spark in the Gulf incinerate the world economy? From orbit, the Gulf glows like circuitry at dusk, each port a pulsing node. Tankers trace luminous arteries toward the narrow throat. One channel, many dependencies. A conflict here would not stay local. It would reverberate through balance sheets worldwide. Look at a map of the Middle East. Find the tiny squiggle of water between Oman and Iran. That is the Strait of Hormuz. At its narrowest point, it is just 21 miles wide. But through that 21-mile gap passes 20% of the world's petroleum. Every single day. Think of it as the aorta of the machine. If you block an artery to the brain, you have a stroke. If you block Hormuz, you have a global seizure. In the first Gulf War, Iraq tried to circumvent this choke point. They failed. But the new threat isn't a conventional army. The threat is asymmetric. It is a swarm of small boats. It is a mine laid in the dark. Or worse, a missile fired from a cave in the Zagros Mountains that costs less than a used sedan, sinking a tanker worth $100 million. The puppet masters don't fear a war. They fear the perception of a war. Because the moment an oil tanker is holed below the waterline near Dubai, insurance rates don't just rise, they vaporize. Dawn over Hormuz reveals a highway without lanes. Supertankers, LNG carriers, and patrol craft weave through traffic measured in billions. Maps show only water, ledgers show cash flow. Any disruption here multiplies through insurers, shippers, refiners into prices you feel at checkout. Before headlines spin, run the math. Supplies tighten, traders hedge, and spare capacity proves smaller than press releases. When fear outruns barrels, price becomes psychology. That is how an $80 market whispers $150, then screams $300. A reflex, not a forecast. Let us run the simulation. Iran closes the strait, or attempts to. Within 24 hours, Brent crude jumps from $80 to $150. Within a week, as the world realizes the closure is not a bluff, we touch $300 a barrel. Now, you might think, I drive an electric car, I don't care. But oil isn't just fuel. Oil is fertilizer. Oil is plastic. Oil is the asphalt under your feet and the synthetic rubber on your steering wheel. A $300 barrel doesn't just hurt at the pump. It breaks the supply chain. Manufacturing stops, shipping stops. Just-in-time inventory, that fragile miracle of modern logistics, collapses into just too late. The financial puppet masters call this a stagflationary shock. You will call it the quiet before the very long winter. And here is the secret the central banks won't tell you. They can lower interest rates to zero. They can print digital currency until the servers melt. But you cannot print energy. When the flow of joules stops, the economy of atoms follows. Fiber lines lace the seabed beside shipping lanes. Blinking repeaters stitch continents together, carrying trades, payments, routing instructions, and the quiet confirmations that make modern trust possible. Disrupt enough of these threads and markets don't merely slow, they fragment. Quotes misalign, settlement stalls, and arbitrage vanishes. In that silence, liquidity evaporates first, confidence second. Screens still glow, but prices lose meaning, because no one can be sure who stands on the other side of the trade. But the oil shock is only the headline. The second act is the digital decapitation. The Persian Gulf is not just a sea of crude, it is a crossroads of data. 14 critical undersea internet cables run through the Red Sea and the Gulf of Oman. These carry 90% of the voice and data traffic between Europe and Asia. In a war with Iran, Hezbollah, or the Houthis, those cables become hostages. A single anchor dragged across the seabed by a proxy militia, and London cannot talk to Singapore. New York cannot clear trades with Mumbai. The global foreign exchange market trades $6.6 trillion a day. That market runs on latency measured in milliseconds. Sever the cables and you fracture the market into 1,000 illiquid islands. Suddenly, your bank in Switzerland cannot verify your transaction with a vendor in China. The chain of trust snaps. The puppet masters have a term for this. They call it the fat tail risk, a low probability event with a catastrophic impact. But in the Gulf, probability is rising faster than the tide. Capital notices before politicians do. As energy tightens and data flickers, investors retreat to collateral they think cannot burn. Cash levels rise, bids disappear, and every risky promise is repriced. Our next chapter follows the flows, from oil income to dollar reserves, from reserves to treasuries, from treasuries back into volatility. The cycle that once stabilized the world can talk the other way. Quietly at first, then all at once, pulling the floorboards from beneath debt markets. And then we arrive at the third, most elegant dagger, the weaponization of the petrodollar. For 50 years, the Saudis and the Gulf monarchies have played a quiet game. They sell oil for dollars. They invest those dollars in US treasuries. The Americans protect the sea lanes, the circle of trust. But a war changes the math. If the Gulf is on fire, Saudi Arabia, the world's only true swing oil producer, is burning. They would need cash, not future promises, not derivatives, hard, liquid, physical cash. The sovereign wealth funds of Abu Dhabi, Kuwait, and Saudi Arabia control nearly $3 trillion in assets. If they begin liquidating their American holdings to pay for their own defense, interest rates in the West explode. The 30-year mortgage becomes a relic. The US government's borrowing costs double overnight. This is the true cascade. Oil spike kills growth, cable cuts kill trade, and the liquidation of the petrodollar kills the debt market. 3 failures. 3 different timescales. One result, a depression that makes 2008 look like a mild correction. Night hides distances and intentions. Drones watch pipelines, terminals, and the narrow approach to the strait. Markets do the same, translating every plume of smoke into basis points. Headlines will say geopolitics, order books will say liquidity. The chapter ahead asks how oil revenues, priced in dollars, can be used as leverage against the very dollar system that prices them. But we have not yet spoken the word that keeps the puppet masters awake at night. The word that cannot be uttered in the boardrooms of BlackRock or the trading floors of the CME. That word is escalation. The Islamic Republic of Iran has spent decades building a ring of fire. Hezbollah in Lebanon, Shia militias in Iraq, the Houthis in Yemen. A conventional war with Iran is not a war. It is a regional chain reaction. But if the regime in Tehran feels it is fighting for survival, the conflict goes nuclear. Not necessarily a bomb on a missile, but a dirty bomb detonated in the oil fields of Kuwait, or a strike on a desalination plant in Dubai. The Gulf region gets 90% of its fresh water from the sea. Poison the water and the city's empty. At that point, the economy is no longer the concern. But for the sake of our simulation, a nuclear first use, even a limited one, triggers the collapse of every risk model since 1945. Gold goes to $5,000. Bitcoin becomes a chaotic rumor, and the only thing that matters is where your food is stored, not your stock portfolio. Cities glitter, yet every light needs fuel and cables. Remember, resilience is a balance sheet and a backup plan. So, what does the elegant investor do? Do you buy gold? Do you hoard ammunition? No. Panic is for the amateur. The puppet master prepares. You diversify your geography. You hold assets that are not priced in the petrodollar. You keep physical cash in multiple jurisdictions. And most importantly, you watch the Strait of Hormuz like a hawk. The next Gulf War will not be declared on CNN. It will begin with a single mine clinking against the hull of a very large ship. A sound no louder than a dropped wrench, but a sound that will echo through every pension fund, every mortgage, and every supermarket shelf on planet Earth. History doesn't repeat, but the financial architecture of the Gulf, it has a very short memory and a very long fuse. Stay liquid, stay skeptical, and whatever you do, don't trust the official narrative.